Hey guys, John the Economist here, and it is great to see you all again. I know it's been a little bit since I posted a market update, and the reason for that is because of the fact that I was finishing up my master's in economics degree at George Mason University. That is all done. I can now actually officially call myself an economist rather than it just being like a little YouTube shindig. Um, so yeah, and with that, right, I got a decent amount more free time to work with, and now all of that focus that was originally towards finishing the degree is now going to shift in towards putting YouTube content out for you guys. A lot of exciting stuff, right? I want to cover some of the papers that I've done, expand on some thoughts that would require a little bit more research and work than I really had as far as time went, as far as putting that content together. So good stuff on the horizon, and definitely plan on releasing videos at a minimum bi-weekly, but hopefully weekly from this point forward. So I'm just going to start this off with a market update to say where we're at for 2023, because it's been a little bit, and yet the exact same three indicators that I've been keeping my eye on for basically the past year are the three indicators that we're going to talk about today: the inflation rate, the federal funds rate, and the United States dollar currency index. And we're going to contextualize a couple things in terms of outlook for 2023 and recessions and things like that. So for those that don't know, I've pretty much had those three conditions listed, right? We need inflation to start coming down. We need the Federal Reserve to stop raising interest rates. This doesn't necessarily mean that they need to bring interest rates lower. They just need to stop raising them. And the United States dollar currency index needs to stop rising. Those are the three conditions that warrant a more bullish, risk on market environment in the future, right? So, first thing that we're going to take a look at is the monthly chart on inflation. And as you can see, we're starting to head down. Now, I've talked about this on the past couple of market updates that I've done. This doesn't mean we're fully out of the water yet. In fact, I would say that that won't be the case until the federal funds rate is sufficiently restrictive, which, roughly speaking, is probably going to be somewhere in the range of like 5.5 to 6% based off of what Chairman Powell and other Federal Reserve board members have said. However, this is starting to look pretty convincing, and I expect this to continue to decline in this month's report. So that's awesome, right? Inflation is starting to come down. Are we out of the woods yet? No. And the reason why is if we take a look at the interest rate. Now, they have done a lot of work in a very short amount of time as far as raising the interest rates go. And as far as forecasts look, they're probably going to raise about another percent. And I'm going to do my best to draw kind of like similar raising interest rates lines here, right? It's going to look something like this, right? Not into 2027, but more so into like 2024 is what interest rates are going to look like. I would say around the midpoint of this year is when interest rates will be sufficiently restrictive, and they probably will stop raising them and hold them steady for 6 months to a year to potentially longer than that, depending on what the economy is saying about the situation. So the Federal Reserve is not done raising interest rates yet. They're slowing their pace. They should be done soon, but they have not finished raising their interest yet, which is creating additional downside recessionary pressure on the economy. And we are starting to see this in things like the housing market. We have not yet totally see it in things like employment, but the cracks are kind of starting to show. The last thing that we want to take a look at is the United States dollar currency index, which I'm going to switch over to a weekly chart, a little easier to do analysis on, and put this into a logarithmic view. Um, Taking a look at this, right, it is clear that there's weakness in this currency index. No doubt about it, right? We've seen this go on a relentless tear to the upside. One would potentially say parabolic, right, over the past year and a half or so. But this was a pretty significant pullback, right? The most significant that we've seen since the dollar index started to kind of go into this like really steady and strong uptrend. In fact, one could even argue that we put in a lower low. And putting in a lower low might suggest that a downtrend is coming. However, I'm not fully convinced yet because of the fact that this range right here kind of seems like a critical area. And we've rallied to the upside pretty strongly over the past few days, right? Out of this potential critical area. So we're going to keep an eye out for this. But I would think that if we take out, I'm trying to figure out if I'm drawing or not still. If we take out this low right here, right, at about 101.5, we can become more confident that a downtrend is occurring. Okay, so all of these indicators have made a lot of progress in the direction that we want to see them go since the last market update I did. So, what's the 2023 outlook then? Are we bullish? Should we start accumulating? Well, first of all, that's not my judgment to make for you. That is completely on you to decide at what point you want to start averaging yourself into the market, if at all. Personally, full disclosure, I have bought zero stocks whatsoever in 2022, and I have bought a little bit of Bitcoin. It's pretty much all I've done as far as 2022. The only things I've been doing is selling, more so in the beginning half of 2022 rather than the latter half of 2022, because I do think we're starting to look relatively bottomy. 2023, I'm probably going to wait, depending on market conditions, right? These things can change at any point. Could have a black swan event, who knows, right? But right now, my current plan is to wait until the Federal Reserve raises rates to be sufficiently restrictive, again, in like that 5.5 range, somewhere in there. And that is the point that I will start accumulating. However, this does not mean we're out of the woods yet as far as economic conditions go. And they might raise interest rates so far that it actually does force a recession, higher unemployment, housing market crash, credit liquidity crisis, any number of factors that are obviously not only going to have downside pressure on the stock market, but downside pressure on the economy. But the thing that's important to remember is that the economy generally bottoms after the stock market does. And the reason why is because of the fact that people already price in their negative economic expectations before those expectations become reality. And then by the time they're reality, everybody's already kind of made whatever financial planning, financial adjustments that they plan on making in response to those conditions, right? So unless we're staring something like the Great Depression in the face that can last for decades, or high inflation that you don't combat with sufficiently restrictive interest rates like the 70s, right? We're not looking at 5 to 10 years of bear market. We're looking hopefully at a few years of bear market. Obviously, I cannot say that statement with certainty. I'm just looking at the conditions and basing them off of past conditions to recognize when it might be a relatively safe time to accumulate versus an unsafe time to accumulate. The last thing I want to take a look at in reference to this is the Dow Jones. And the reason why is I want to kind of show like how long some of these bear markets can last, kind of what I was alluding to in my last statement. So let's see how quickly I can grab this. Cool. So taking a look at the top of the Dow Jones to where we're at today, we've been in a bear market for basically a year, right? Like pretty much to the week. We've been in a bear market for a year. Okay, cool. How long? And we are going to measure this, by the way, from the top to the current bottom, right? For our current bear market, right? We don't know if we're done yet. The rest of them, I'm going to be measuring from the top to the bottom to signify how long the bear markets were. So for the COVID bear market, right? I don't even know if you could call it a bear market. It's more so just a black swan capitulation event that lasted about 70 days. It was like 3 months before went on this crazy move to the upside, right? Now going to some of the more important ones that are worth looking at, we're going to take a look at 2008. Top right there, bottom right there. That bear market lasted about 2 years, 525 days. Going back to the dot-com bubble, top right there, bottom right there. That bear market lasted almost 3 years, right? 1,000 days roughly. So those are all the significant bear markets that I've lived through, and this is the first significant bear market that I've lived through as an investor and trader. So then taking a look at some other significant ones, right? 80s were pretty good for the stock market. 80s and 90s were, and then you take a look at this really bad inflationary period that I was discussing, and like it was just sideways chop for about a decade. That is not an understatement whatsoever. So you could potentially call that a bear market. You could call it an accumulation zone, right? But I wouldn't call any of these bull markets, right? They're little tiny bull markets that don't do anything, right? They don't set new highs or anything like that. So this would be the outcome that obviously would want to avoid the most, right? Where like, you could call that a bear market in the late 60s that lasted about a year. You could call this a bear market in the early 70s that lasted about 2 years, and call this a bear market in the mid 70s. This is when inflation was really being relentless. That lasted about 2.5 years. And then you can call this a bear market that lasted in the late 70s into the early 80s that lasted like 4 or 5 years, right? And then if you just consider, okay, this entire thing was just one large accumulation range because no new highs were set and we just went sideways for a while, you could reasonably say that this was a 6,000 day bear market, right? It was a 14-year roughly bear market. Now, obviously, I am simplifying quite a lot, and the reason why for that is because even though you could call that just a long accumulation, money was still made. Why was money still made? Because this was a 70% move to the upside. This was an 80% move to the upside. This was a 34%, right? So like there was moves to the upside through this, but like, right, compared to what came after it, that's you cannot possibly call that a bull market, right? You just have like these relief rallies and these recovery rallies, but like you're not going anywhere. You're going sideways, right? So we're trying to see something like this happen again in order to call it a bull market, right? Like that's just up over the course of a decade rather than sideways over the course of a decade. This was brutal for investors. Not fun at all to be investing in, right? Because you're like, if you invested even in the midpoint of this range, a decade later, you'd be like, man, I haven't made any money whatsoever. Like, I'm here, right? Most people aren't trading this. And if they are, they're not trading it well, right? That's the nice part about bull market is even if you're a bad trader, which most of you are, right? Most people are, that wasn't an insult, then like at least a bull market kind of bails you out along the way. But a bear market like this, right? You're not getting bailed out. Like if you're making bad trades, nothing's going really your way. So, anyways, so like long range, right? We've been in a bear market for a year, but every bear market that has preceded this one has lasted quite a bit longer than a year. So I don't think we should be like up only mentality right now, especially given we don't know the effect of the interest rates causing recessionary pressure and how bad that recession is going to get, right? So like right now, everybody's admitting it's a bear market. And that has me confident that it might be, time to start keeping my eye out for a bottom and start potentially looking to average into some things in the coming months here because everybody thinks it's a bear market, right? When everybody is like, "Oh, we're bullish," right? That's when we were topping out pretty badly last year, right? Um, but right now, you'd get made fun of if you were bullish on basically anything. But as far as the economy goes, not everybody's calling it a recession just yet. We all see the recessionary pressure. We're not stupid, but I don't think anybody is blatantly calling it a recession. The jobs report looked great. Inflation's coming down. Commodity prices, which obviously contribute to inflation, like oil and lumber and electricity, are starting to come down after a rough year of that, given fun geopolitical situation. So we're not out of the woods yet, is kind of where I'm trying to get to. And this would be a historically short bear market if we're out of the woods. So, my suggestion would be to remain cautious, to keep an eye on these long term macro indicators and just kind of figure out when it's not, a horribly risky time to start averaging back into the market. That's essentially what I would do, guys. I promise. Once I make some bull market money, I'll get TradingView Plus, so you guys stop having those ads pop up that I have to click out of. But I'm too frugal now. And taking a quick look at Bitcoin, right? Like I have the exact same feeling about Bitcoin, and the halving will probably be a nice boost. But we'll probably go sideways or down. So right, somewhere in like this kind of general range for a while. And then in anticipation of the halving, we might start making our way up. And look, you can't possibly predict that. This is the first time Bitcoin's dealt with a recession in a long-term bear market. So, past performance does not indicate future results. And just because Bitcoin has looked like this throughout its entire history doesn't mean that we can't see more downside pressure, right? And look, I'm confident in this asset long term, personally, but there might be some time for volatility in the near future. We'll see what happens. But yeah, that's pretty much my thoughts. Summing up, the past month or so of market action. And like I said, excited to start doing these on a more regular basis, and then also get some of the content over out there. Reviewing some of the papers that I did while getting my master's, and just a few other fun things. So, hope you guys have been doing well. Hope you guys have been weathering this market storm okay, and hopefully 2023 is not as brutal as 2022 was if you are an investor and trader. So until next time, have a good one. Peace.